Hello, investors. Welcome and thanks again for listening to me, watching me through Mali Investment Talks. I hope that you get some value in terms of empowerment, in terms of being able to make competent decisions. And please do remember to get back to me, reach out to me. Some of you have indeed been reaching out to me, have been giving me feedback. I appreciate all that. Let's keep it that way. We have been talking about the do's and don'ts of different investment products that, or investment, if you like, assets that you could make a part of your investment portfolio. We talked about bonds, we talked about shares. Today, I want to talk to you about unit trusts or mutual funds, as some people would call it in other parts of the world. What are some of the do's and don'ts? And again, I did speak about unit trust before, but I would like to recap and tell you some of the, besides the do's, some of the don'ts, some of the things that you need to watch out for. So remember, a unit trust would be some kind of an indirect investment vehicle, in the sense that you are giving your money to an investment manager who then manages it on your behalf, invests it on your behalf, and credits your account periodically, monthly in most cases that I know in our region. It will be monthly crediting of your account, and you get your statements therefore monthly, so you know where you are. That is essentially how it works. And the fund managers are usually well-regulated entities, and generally therefore your investment through them tends to be at a low risk generally. The unit trust will therefore be a good way to diversify your investment in terms of different asset classes or different assets. You are able to diversify it through the skills of a manager, an approved manager. So you don't have to be an expert anymore in any of these issues, in investment issues, because you're taking advantage of the skills of a professional. A unit trust will very importantly help you to compound. I cannot overemphasize the value of compounding to the growth of your investment portfolio, and therefore by extension to the growth of your wealth. A unit trust will help you to compound, meaning it will automatically reinvest whatever returns, the interest, or whatever is credited to your account. It automatically reinvests that, and thereby accelerates the growth of your wealth through your investment portfolio. A unit trust gives you an opportunity for flexible investing, so you can top up anytime you want, pretty much any amount that you want to top up or to add to your investment. You don't easily get that from other investment vehicles. A unit trust enables or allows you to do that. A unit trust is very liquid, so that means you can redeem your money in part or in full pretty much at any time. And it does all that, like I said, at a very low risk. Now, a few things to watch out for though. So we talked about, for example, the liquidity being high, the fact that you can redeem your money anytime you want in whatever amounts. That is great. But if you are looking for long-term growth, well, you will understand that that could pose challenges. The fact that you have easy access to this money means that your levels of temptations are also going to be high. So that can compromise your ability to get long-term growth. So that is something you need to be aware of. Unless, of course, you have extremely high levels of discipline. If you don't, then it can be a challenge. Second thing in terms of things to watch out is the quality of underlying investment. So remember that when you invest in a unit trust, you are not now the one directly investing in, I don't know, that share or that bond or whatever. The fund manager is doing that on your behalf. So you now, if you can, try as much as possible to get a sense of the underlying investments. What are the products that the fund manager, or what are the assets that the fund manager is investing your money in? By extension, in the industry, we say check the asset allocation. So you don't necessarily, even if you don't know the exact assets, so company X shares, bonds issued by company Y, even if you don't know that, check a sense of what proportion of the total portfolio of investments is the fund manager allocating to bonds, for example. What proportion or what percentage are they allocating to treasury bills? What proportion are they allocating to shares? What proportion are they allocating to fixed deposits? And so on and so forth. By understanding that, you get a sense of maybe the level of risk that your fund manager is exposing you to. Now, this asset allocation information is or should be information available to you. No one should be telling you that, no, that is sort of a preserve of the fund manager. I have had some fund managers tell their investor, if you give me money to manage, then that is my responsibility, including asset allocation. Yes, that's great, but you do have a right as the investor to know how your money is being allocated. So please do ask for that information. Some fund managers do a good job of publishing that information in the press, but where they don't, certainly before you invest, I would urge you to check the asset allocation, check what are the underlying assets, underlying investments into which your money is going to be invested or has been invested in the past. Okay? Very importantly, also, please always try to understand the costs of investing, the structure of investment charges. Okay? So, the management costs. Get an understanding of what is the charge related to management in percentage terms, for example, per annum. How much are you being charged for management? Is it 2%? Is it 1%? Is it 1.5%? And that might vary from fund manager to fund manager. So then if you understand that, it will help you to do a bit of shopping, check with the different fund managers, because ultimately, my dear friends, a difference of 1 percentage point or 0.5 percentage points with respect to a particular charge will make a significant impact in the long term, especially in terms of the total return that you will get from your investment. So never ignore those little differences. So check on the management costs. As I said, check on the general structure of charges or fees. So what I mean here is some companies, for example, some management companies will levy on you what we call initial fees. In other terms in the industry, they call it front loading. Okay, so they make sure that they get as much from you as possible before you even begin investing. So if you were, for example, investing, say, $1 million Kenya shillings, all right? In some companies, if the initial fees is, for example, 5%, which is high, it means that you're basically going to start by investing only 95% of that 1 million Kenya shillings or 30 million Uganda shillings. So you are only going to start with 95% of that. You need to be aware of that. And therefore, this move on maybe and check other investment managers or fund managers who may be charging a little less. So look out for those initial fees, or what we call front loading, like I said earlier. Look out for those management fees. Again, some companies will charge you less, some will charge you a little more than others. Look out for any other hidden costs. Okay? Some companies will maybe or maybe not charge you initial fees, but they will defer the charges to the time that you are exiting. All right? So you just need to understand that too. The structure of costs, the structure of fees, and the extent of the fees, especially as compared to others. Very, very important. And like I said, do appreciate the fact that any small difference in fees, it could be, don't focus on the absolute difference, or 1 percentage point, oh, that is small, or 0.5, no, that's not small at all. In the long term, it compounds and it will affect the return that you get from your investment significantly. Ladies and gentlemen, thank you once again for listening to me. Again, as I've been saying a lot of times before, there can never be enough time for me to tell you everything that you need to know about any one of these products or topics in investing. So the only way you are ever going to do that, or to get as much information as you need, is to continuously reach out, use the contacts that you have at the bottom of your screen, reach out to me, or indeed reach out to any financial advisor to get out or get more information about these very important subjects that we are discussing. Otherwise, thank you for listening, and I look forward to talking to you on subsequent investment topics.